Per usual, everything on this channel is for educational purposes only. It is not intended as financial advice. I had a question the other day from someone in the comments about Bitcoin miners. So that sparked an enormous rabbit hole for me to go down. Let me start with a little bit of background on miners, where you can get excellent data for free and kind of everything that's worth paying attention to when trying to understand miners. Now, historically, miners were located in China, and everything out of China is pretty much a black box. We had some vague idea where miners were located, how they would migrate, depending on the wet and dry season, using renewable energy. Then there were miners in other places and in other places in China using coal, using stranded energy, Venezuela. So the data we have today is several degrees of magnitude more transparent than we did in years past, because the industry has grown, the industry has matured, and a lot of this stuff now is publicly traded, at least the industrial miners. From the beginning, we could always see some data. We can still see that on the chain. We can see the types of ASICs mining, for example. They tend to leave a fingerprint. Coinmetrics has great data on that. So when you hear about mining, obviously you hear about hash rate. That's the total compute power of the network. Difficulty adjusts every 2016 blocks up or down to target a 10-minute block time. So if you're a miner, you want difficulty to decline, which hasn't happened historically. You want your hash rate relative to the rest of the network to increase, which is difficult for many miners. Everyone is trying to essentially buy the same ASICs on the market, right? Assuming they have the money to do that. Now they can either go to the lending market and go into debt. They can buy from the manufacturer directly. Then we're talking about industries of scale. We're talking about logistics. We're talking about dealing with thousands of machines. We're talking about electricity costs, noise, heat, weather, regulations. I mean, the list goes on and on and on. As you scale, each of these components that I just mentioned becomes increasingly important. So starting just with difficulty, we look at historically how we got to now. Basically, what we've seen is enormous increases in efficiency. And I think it's pretty safe to say that Satoshi never saw the ASIC industry coming and or what this actually meant for the Bitcoin network. Whether or not the intention was always one CPU, one vote, which is more of like the Monero route, or what has now essentially become, a separate industry. You and I can mine with ASICs. Our individual profitability outside of a pool is extremely poor. In a pool, highly dependent on your individual hash rate. And from an industrial perspective, again, then we're talking about location, electricity costs, all that other stuff. The good news for the network is that mining is extremely distributed. It's on-grid, it's off-grid, it's in the United States, it's in Dubai, it's in Iceland, it's in China, it's everywhere. South America, Canada. It's becoming increasingly decentralized from a location perspective, which is great for the network. The mining pools, which I'll get to in a second, have become semi-centralized, which I think is an issue, specifically Foundry. But let's start with the ASICs first. One way to, again, this is a video about analyzing, at the end of the day, it's analyzing the publicly traded miners because that's what the goal is here. But in order to get to that, we have to sort of understand a few things, because you can also invest in some of these miners, Canaan being one of them, right? Do you want to invest in the shovels or the companies doing the shoveling, basically? That's how this boils down. And we can analyze the releases of these ASICs, how that affects the network, where they go in the world, the power consumption. The noise issue at scale is tremendous, deafening, and increasingly problematic when we're talking about throwing thousands of these machines in typically very, very rural areas, but not always rural areas. Sometimes it's, neighborhoods with people. That can be an issue. That can be a public nuisance, right? But if you want to look at the profitability of these ASICs individually, you can look at electricity costs and search the SHA-256 ASICs. Another issue with this is historically ASICs have been basically used to mine the network before they were actually shipped to the customer. I don't know how much of that actually happens anymore, but historically that was a major problem. You're also dealing with from a miner perspective, pre-ordering these miners, you'll see tons of articles every now and then about, so-and-so has bought thousands of miners from so-and-so. That takes time to manufacture, to ship, to install, and to energize. That's a whole separate logistical pathway to consider. So that's the ASICs side of things. Now, pools came online when it just became more advantageous to group together from a hash rate perspective rather than solo mining. And I'd say the most problematic pool from a percentage of the network perspective is Foundry. Now, they're probably the most trustworthy. Historically, we've had issues with pools approaching 51% and what that may mean for the network. Foundry's at 30%. Not a big deal right now, but I honestly thought their percentage would decline more significantly when they added fees. Historically, they never had fees for the pool. That's a whole nother separate conversation. What pools do these miners use? Are the pools located in the United States? What are the fees for these pools? Are they solo mining? Are they using their own pool like Marathon? Certainly something else to consider. So a few places to look at: hash rate and difficulty, BitInfo charts, OG website, still kicking, just exactly what you want. Super simple analysis. Coinmetrics, another OG data site, free in case you're looking for mining data. BTC.com. This is where I typically go to look at pool distribution. Now, a lot of the stuff I'm talking about initially, not super important for the publicly traded miners, but it's important, I think, to just understand what this information means and where to get it. So over the past 3 days, 30% of the blocks have been found by Foundry, and this will change over time, dependent on which miner is using which pool. As we get more industrial, ideally we see, who's using which pool. Not always the case, but in the US, it's pretty much always going to be Foundry. Brains is another good website for this information. They break down the headquarters of each pool by country as well. And I really like to see the hash rate of Foundry decline. Great people, great pool, somewhat adjacent to DCG and Barry, but at the end of the day, from a network perspective, we do not want to see this continue to creep up. BTC.com also breaks down each difficulty adjustment. Now, historically, when difficulty adjustments are negative, that typically means stress in Bitcoin price, stress in miners shutting off, right? We've certainly continued to increase throughout 2023, even late 2022. A lot of that just being increases in efficiency, new ASICs being deployed and turned online, and just new mining avenues, off-grid, natural gas, landfills. That's slow in a smaller slice, certainly, but that's going to become a bigger and bigger slice over the next few years. Another great spot for data, Luxor hash rate index. This gives you an idea of the expected value of 1 terahash per second per day. And you can see that it is rough out there for these miners right now, right? They're also long transactional activity of the network. They're long transaction fees. So it's important to understand what's going on there. And just because transaction fees are up in the network doesn't mean you'll see that on the share price of the stocks either for these publicly traded miners, right? There isn't always going to be a one-to-one correlation there. This is hash ribbons, and it's another way to measure stress in mining. If we look at 30-day, 60-day hash rate changes, historically when this has crossed, it has represented a decent time to buy spot Bitcoin, right? Just eyeballing it, these levels historically since 2019, not bad for buying, right? We're currently sort of in the midst of a similar hash ribbon cross. Now, the problem of looking at this versus historic data is the network is very different than it was in 2021, in 2020, right? It's not just China anymore. We're talking about Texas and ERCOT and curtailment. And, oh, by the way, miners are also short the temperature. Okay, if the temperature goes up, they have to shut down. They get paid for that in Texas. They may not get paid for that everywhere in the world, right? And temperatures also hit the longevity of the ASICs. All in all, mining is just a very, very hard business over the long term. Another great place for mining data that's free, the block. Again, you want miner revenue. If you're a miner, you want your subsidy, your block reward revenue in USD to be high. You want transaction fees to be high because that means you're more profitable. And really over the long term, we need to see transaction fees as a percentage of the revenue replace the subsidy, right? The block reward. So we're a long ways from that. And miners they have to be optimistic on transaction fees rising, prices rising, activity of the network rising, because the halving is coming up. I'll look at the break evens in a second, but their profitability based on the block reward input of that equation is about to decrease by half on the BTC side of things in April 2024. So they need to be ready for that, or they just won't be in business. A few more great resources. Galaxy puts out reports on mining. They just put one out. It is in-depth, highly recommended reading if you're curious about the Bitcoin mining ecosystem. If we're just looking at geographic location, right? Okay, we can't be located in Tornado Alley. Ideally, we can't be located in high stress environments for temperature, for hurricanes, right? We have to think about all that stuff. We also have to think about regulations as this industry gets bigger, and where we're seeing at the state level many positive and negative, regulatory implications. So just because Texas or New York may be opportune to set up a mining company, or the mining company is currently located there, right? They may get kicked out of town based on regulations. So also something to keep in mind with all of these companies that are publicly traded. Luxor, the hash rate index, also just put out an excellent report, massive. At the very end, they break down Bitcoin mining around the world, just in case you want some info and blurbs on at the state level and at the country level. Maybe not super important for even Bitcoin price. At the end of the day, everybody just assumes that everything's going to work out. But if you actually want to dig into where this is happening, they break that down. Probably most interesting for us in the United States, at least for me, I'm just curious, where are all these miners located? We hear a lot about Texas. This was a great breakdown from Luxor again. Number of facilities, total hash rate. This was as of Q4 2022, so this has changed a little bit, undoubtedly. But you're still seeing a ton of hash rate in Texas. The hash rate in Georgia, a lot of that is CleanSpark. But I expect this to actually continue to expand. And one thing to also note is, where are the electricity costs most beneficial? This is just their hosting numbers, but just as an idea, California has some of the worst electricity, the highest electricity in general. But there are many, many, many factors that go into electricity costs. So it's also something to consider here as a factor. And they are saying, Minnesota is the cheapest state based on their estimations of this specific ASIC, which for me, hey, that's a surprise based on my knowledge of electricity in the United States. So a lot of these I have in a Bitcoin mining list. I'll put that in the description of the video, just in case you want to see that. Now, you can foolishly, like I started to, make this list of all the publicly traded miners and start to break this down. Like, what I care about from publicly traded miner perspective. What is their current hash rate? What is their future hash rate? And how does that relate to their market cap? For instance, if I'm looking at Hut 8 versus CleanSpark and I'm investing in these individually, not investment advice, but one way to analyze this that I would care about is, okay, CleanSpark almost has 3 times the hash rate of Hut 8 based on the available data I was able to find. Why are they worth less than Hut 8? That makes no sense to me whatsoever. Iris is another one that sticks out from a market cap perspective, from a fundamental perspective, right? Undervalued based on its hash rate. This isn't saying anything about the business, the debt to equity, blah, 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 right? You can go down the list. Just as the basic first pass for me is stuff like this, right? Why is Mara, why does that have a lower market cap than Riot, even though they have almost twice the hash rate? Something else also worth noting is how much BTC they're holding, because in a bear market, they're going to get crushed. In a bull market, depending on how and when they sell this stuff, they're going to do extremely well. Now, this worries me. I wish this column was a bunch of zeros, honestly, because are they a miner or are they a hedge fund? Are they using some sort of strategy, which historically many of them did through Genesis, to manage this? Or are they strictly buy and hold, which is what Marathon has done? From a Bitcoiner perspective, awesome, amazing. But again, like I said in the last video, whales are bad. Whales inevitably sell at the worst times because they have to, okay? It usually doesn't lead to a happy ending. So that makes me nervous. To me, this is just sell side pressure that's going to kick in to limit prices going up, or it'll extend the downside pressure when they have to sell for whatever reason. So hey, maybe I'm just too negative on whales, but that's how I see it. And interestingly, some of these miners, like Bit Digital, is holding ETH and staking ETH. I don't know how exactly that fits into the business model. I'm assuming they were mining ETH with GPUs before it went proof of stake. I don't know too much about that company, honestly, but one other thing to consider here with miners nowadays is what are their hosting capacities look like? What is their plan for AI and pivoting? Do they have GPUs? Are they acquiring GPUs? Some of these companies do, and that may affect their market cap, their stock price as well, right? It's not just all Bitcoin. So for me, just based on this initial list, anything below Iris is probably in a void. Anything that's gone through or still going through some sort of bankruptcy proceedings, regardless of how big they are, that's just not a headline that you want to be connected with, in my opinion. So a better way to do this is to lean on some free resources, one being Miner Mag, which honestly I didn't know they had this data breakdown until today, because it is amazing. They're pulling all this from the SEC filings basically instead of doing this yourself. So they have some really, really good data on the business side of all of these miners. And like I was mentioning about the cost of Bitcoin mining, some of these miners, their cost of Bitcoin, their break even is above price, right? Hut 8 and Wolf. Again, if I'm looking at Hut 8 versus CleanSpark or something, and I'm trying to analyze just from a stupid simple perspective, who's going to be okay after the halving, Riot might be positioned a little better than TeraWolf, for example, right? And you can also look at the non-all-in cost. So definitely I would use Miner Mag for the data for these companies. This is something from Ecoinometrics, and this is kind of a problem, I think, on the spot side of things. If we look at one analogous industry, gold versus gold miners, historically, gold miners may have had higher beta, which is what we're seeing here relative to gold. But I don't think they had this sort of outperformance picture. And this may hurt the spot side of things if there is no institutional vehicle yet. And, this is what people are investing in instead, which is totally fine. But we aren't seeing that on the spot side of things as much as we're up this year. And here's Argo at the bottom. I think Argo's in trouble, honestly. I just don't like the chart. I'll get to that in a second. And I think they just had some debt raise or something. It's not a great outlook from what I can see. My non-Galaxy brain understanding. One other way you can pick up these miners, before we talk about the individual charts, is to look at ETFs, which are just a basket of these stocks or equities, right? This is sorted by the year-to-date performance. The purest of pure plays from a miner perspective would be WGMI, which is one of the reasons, in my opinion, it's done as well as it has. It's also managed extremely well. Shout out to Bill at Valkyrie there. These other crypto ETFs, blockchain ETFs, when you dig into the holdings, which you can do on this website, ETF.com, when you dig into the holdings, you'll see that they contain all sorts of stuff that isn't even kind of semi-related, in my opinion, to crypto or Bitcoin or blockchain. But if you want Bitcoin miners, the stupid simple thing to do is WGMI. One other thing to look at with all of these is what is the expense ratio, and you can compare it from there. So there are a few of these now, but I think the easiest way to play the miners specifically is just WGMI. Now, if we look at GLD, which is the gold ETF, versus GDX, which is the gold miners ETF, kind of a big difference since launch in GLD versus GDX. So my initial evaluation of long-term growth of miners based on this, right, would be just buy spot, buy the underlying. Now, what may change on the miner side of things is that AI picture, that data hosting picture. Who knows? Maybe they go into room temperature superconductors. I don't know. But this doesn't give me a lot of hope over the long term, right? In the short term, there may be higher beta, but as a buy and hold, looking at similar industries, this is tough if I'm investing in Bitcoin miners. Another thing about Bitcoin miners is historically they've been in this boom bust cycle. So anything that can break them out of that, they'll do really well. When Bitcoin does really well, they'll do extremely poorly when Bitcoin does poorly, right? and you get these 4-year cycles. Not exactly amazing generally for a buy and hold. Something else to consider. So if we look at individual, well, okay. So let's look at WGMI versus BTC, right? Here's a perfect example. Since launch, WGMI has never really outperformed spot. As well as it's done this year, right? It's up 200 something percent, 250% this year. Since launch, right? It has not outperformed, which is maybe surprising. You know, Bitcoin's still down 33% since WGMI launched, beginning of 2022. So it'll be interesting to see if that higher beta kicks in when things get more bullish. Now, year to date, it's outperformed. You know, WGMI has outperformed, right? A lot of these miners have outperformed. But over the long term, what happens? And from a year to date perspective, it's what? A 3x performance relative to Bitcoin at least. So timing is pretty critical. All right, let's go over some of these charts. Now, I could literally flip through every single one of these charts in a second and immediately know what's going on because I'm using the cloud. I'm using 1852, 104, 26. And throughout 2021 and 2022, most of these mining charts, you'll see some sort of bearish channel, parabolic downtrend, definitely bearish on the cloud. And year to date, all of these have looked excellent except maybe Argo. So the read for all of these is they are all bullish. They all, from a trading perspective, long entry perspective, you would want them back at the Kijun. And that's it. You know, they are bullish. I do expect them to mean revert a little bit to the downside. But if I'm just looking at the charts, they all look great. Mara, same thing, right? Looking for that Kijun level as far as a long entry. Cypher, already there. Still looks relatively bullish, right? Now, you'd have to dig into the business side of things for some of these miners, which admittedly isn't so rosy. And miner, Cypher maybe being one of them. Hot 8 almost at that level on the Kijun, right? Coming out of that bearish move in 2022. Still looks good from a bullish perspective. CleanSpark, which I think honestly is my favorite miner because from knowledge, they sold everything as they were mining it in 2022, maybe even prior to 2022. And their hash rate relative to market cap, to me, looks like they're undervalued. Do I know anything about the business side of things? I don't, but just looking at that one metric, I really like CleanSpark. TerraWolf at the Kijun here has pulled back quite a bit. And just from a technical curiosity perspective, it's interesting to go through these charts, looking at what happened during the downtrend, right? Were they parabolic? Were they bearish channel? Was it some sort of broadening wedge? How did the cloud do with all that? I mean, the cloud, in my opinion, did excellent with all this. Hive, same thing, pulling back at the Kijun, ready for maybe a retest to that 4 level. I mean, this is very, for me, very easy to just look at this and say, okay, yeah, these look okay. Kijun, are we there yet? Bitfarms, almost. And for the most part, all these are going to look the same. BTBT, Bit Digital, amazing downtrend below the cloud and amazing trend above the cloud. Something else to note with a lot of these miners, or maybe all of them at this point, some sort of SPAC or reverse merger was involved early on with many of these. So that's going to change what the data looked like prior to 2021. Just keep that in mind. You know, I wouldn't look at what these looked like 10 years ago because that just wasn't representative of what the miner actually was. Iris Energy, same thing, getting ready to pull back to the Kijun. Next level down at like 450, something like that. Still bullish. Argo, looking very, very different relative to the rest of the charts, right? Below the cloud, does not look bullish in any regard. Another reason just to be concerned with this company just based on how it's trading. And then DigiHost looking fine. You know, maybe there's some sort of pattern here, but all in all, those charts looking okay. Individual miners, for the most part, still bullish, pulling back. Some people use them as a metric for spot prices, looking at the moves and reactions of those charts relative to spot. Sometimes they lead spot, like Mara and Riot. Sometimes they lag spot. I think once we have an ETF like GLD, those lead lags, those correlations may break down a little bit. Now, if we look at the ETFs real quick, same thing. You know, this is WGMI. It's at the Kijun. Looks okay on the daily. It's got significant downside if it breaks the Kijun, and if it does turn more bearish, something like 1250 looks pretty good. But literally, I can look at all of these. They look the same, right? If we go, these are all the ETFs, DAP, BKCH, BitQ, Saito, however you say that, IBLC, right? FDIG. Doesn't matter. This comes down to fees. It comes down to access and your opinion on the individual holdings of these ETFs. But again, if you like miners, Bitcoin miners specifically, this is really the last surviving ETF. It's purely Bitcoin miners. So TLDR, lots of data to look at, lots of things to consider. Potentially none of it even matters when we're talking about the mining stocks. In the near term, over the long term, halving is going to matter bigly, obviously. Efficiency, electricity costs, location, regulation, all that's going to matter immensely. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.